Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to be with you once again. I'm really happy to have Alasdair Macleod with us once again. He's, I guess, next to Michael Oliver, he's probably the most frequent guest because I just really value what he has to say. I think he sees the underlying dynamics. You know, most of the time when you're watching mainstream television or radio or whatever, the media is going to give you the Keynesian version of what's happening. And the Keynesian model is highly flawed in my view and Alasdair's view, and most everybody that follows the Austrian School of Economics believes that it's out of touch with reality, the way the world really works. And Alasdair really digs down into below the surface and provides us with an understanding of what is actually driving the markets. And that is helpful because if you understand that, you're in a better position to see what's coming. Thanks for joining me again today, Alasdair.
That's my pleasure, Jay.
It's always good to have you with me. And, you know, I believe it's every Thursday that you publish your essays. Is that right?
That is correct, yes.
Every Thursday at Gold Money, so people can go to goldmoney.com. And, you know, it's a must-read from my perspective to try to keep up with things. And, you know, we have Alasdair on about once a month. Could really have him on every week, honestly, because every week there's his essays are well worth spending time on and learning to understand them. Well, Alasdair, we titled today's show after your February 13th article titled Coronavirus and Credit, A Perfect Storm. And, you know, you've been warning that the existence of this credit cycle, it's getting long in the tooth, and it's very vulnerable. It's you know, a lot of bad things could happen. The credit cycle coming to an end, and usually when it does, because it is a credit bubble. Really, it's not based on natural market forces, but rather Keynesian economics pumps these bubbles up, and then you have a very sad ending to it. Usually, a very cataclysmic ending sometimes. So, what do you see? Could you talk to us a little bit about what you see? Why the credit cycle itself, let alone the coronavirus, is in some trouble?
Well, the credit cycle, the expansionary phase, was really coming to an end. We've seen that with statistics coming out showing that the global economy is slowing. It's not just China or Germany, but it's everywhere else. I mean, virtually every statistic which actually comes out of the private sector rather than out of government has shown that the economies everywhere have been slowing down. And most notably, the international trade has almost run into a brick wall. I mean, we see things like the Baltic Dry Index just completely collapsing, you know, freight figures going way down and so on. So international trade really has run into a brick wall. Now, the reason for it is really twofold. You've got a combination of the credit cycle, which has run up to its peak, and bankers are becoming cautious, so they're tending not to lend money to the small and medium-sized companies in say, America. The same is true in the UK and also Europe, because they see risk. So having been sort of pushing people to borrow, they're now sort of drawing in their horns. And this has coincided with President Trump's tariff war against China. And if you take the combination of these two events, guess what? We're back in 1929, when the Glass-Steagall Act was introduced at the end of October 1929, and that was the month when Wall Street started its crash. So we have a very disturbing similarity with this situation. So without the coronavirus, we are heading for a slump, and that's the only way to describe it.
All right.
Market crash and slump.
Well, speaking of market crash, we had the Dow Jones was down over 1,000 yesterday. With about 20 minutes left in today's trading, it's down 880. You talked in your article about a sudden collapse. And, you know, unlike the kind of a scenario where you might have some time to prepare for it, why do you see this as, I mean, do you think this is the beginning of something very serious here the last couple of days?
Yes, I do.
In the financial markets?
Yes, I do. I mean, the coronavirus, if you like, it gives us such a clean indicator of timing. It is disastrous. It has shut down the Chinese economy. It is shutting down economies elsewhere, or if it hasn't already, it will be. I mean, places like Korea, the motor manufacturers have stopped the production lines because they haven't got vital Chinese components from their supply chain. The same is true of almost every motor manufacturer. Almost every electronics manufacturer relies on components from China. I mean, look at Apple, for example. So, all these businesses are suddenly having to grind to a halt. And what does this do to everybody's GDP? Well, it contracts.
My
and
goodness.
So not only do we have the setup for a repeat of 1929, but we have this coronavirus coming at precisely the point when the whole thing is due to descend into a slump anyway.
Yeah.
Now, the thing that's so important about this is to realize that the Fed has it's effectively caught with its trousers down, because what they have done is they have mispriced the market. And let me describe it this way. If you bear in mind that there is a time preference for a 10-year bond, and that is probably around about 2%, we have an official rate of inflation of around about 2%. But if you go to the independent analysts, the figure is more like 10%. So what should the 10-year Treasury bond yield? Well, if you've got inflation running at 10% and you have got a time preference value in there, which we can't really determine, but let's say it's round about 1 or 2%, then that should be yielding at least 10%, maybe 11%. So that it should be priced with the current indicated coupon of about 1.37, I think it is. That should be priced at under half, under 50. I mean, that is how mispriced the market has become. Now, sooner or later, the market will reassert itself, because this distortion cannot go on forever. It never does. And when the market reasserts itself, just think, if you're going to collapse the value of U.S. Treasury debt, what does that do to the stock market? What does it do to every form of financial asset? I mean, it just cuts the feet out from under it. And at the same time, the foreigners who are overweight in dollars are going to turn sellers of the dollars. You've got the hedge funds who have been buying dollars and selling euros in order to strip the rate differential. Most they've been doing it through FX swaps, which means that the banks have been doing it for them, but it amounts to the same thing. So I don't know, you've got probably about 4 trillion of liquidity, if you like, in the foreigners' hands. You've probably got about another 4 trillion of swaps, of FX swaps related bull positions in the dollar. You have got $19.5 trillion worth of securities, which are not bank balances, owned by foreigners on top. Now, I mean, they own more dollars than the US GDP. So we have this situation where they're certainly not going to be buying any more debt, because they've got no need to do it, because with the global economy contracting, you don't need the sort of dollar balances that you thought you might have to have yesterday. So you're descaling on that. And consequently, foreigners are going to turn sellers, and they will drive the dollar down. At the moment, nobody really understands this, and they think the safe haven is to go and buy US Treasuries. And that is why the yield on US Treasuries has collapsed. But it's wrong. That is actually where the risk is. And as soon as people realize it, then I'm afraid that the dollar is in for a collapse. And, it's a collapse. It's an initial effect, if you like, against the euro and against the yen in particular, which is where all the unwinding is likely to occur. There will also be unwinding from other nations. The Chinese, for example, are likely to start drawing down their debt more aggressively. The Japanese will probably be forced to draw down as well. I mean, it's one thing to hold on to US Treasuries while the dollar is rising. But when the price of US Treasuries is going down and dollars are going down with it, as a foreigner, you're getting hit twice. So what do? You just get out. And that is, I think, the problem that is going to be ahead of us, because of the overpricing and this dramatic overpricing of U.S. Treasury debt.
Well, you were talking about the speculators, the currency carry trade folks and how they were stripping the difference in rates, thinking there was no risk there. But that plays in also to the repo markets, I believe, the repo problems that we've had in the repo markets recently. Could you comment on that, perhaps?
Yes, of course. The repo problem has arisen because the prime brokers have had to carry more US T-bills and bond coupon debt. And at the same time, these hedge funds have been taking out their foreign exchange swap positions in increasing quantities. And what you don't have is you don't have foreigners buying, sort of recycling their dollar, the dollars from their, their exports into America. They're not recycling those anymore into the market, so into the money market. So what you have got is you've got a shortage created by the absence of this recycling on the one hand, and on the other hand, you have got the sort of, if you like, the increased domestic demand for dollars in the market to finance these foreign exchange swap positions, and also the larger and accumulating inventory of U.S. Treasury debt being issued by the government, and the banks just can't take it anymore. And that is why you had the spike in the repo rate back in September. And what that is telling us is that the right interest rate in US money markets is actually far higher than the current level. The Fed is having to intervene to keep it down. So we have got a liquidity crisis which is not happening courtesy of the Fed printing money. And this is printing money. I mean, talking about printing money, that was before the coronavirus. I mean, that is going to lead to so much more printing money. And so you can see that there's a tsunami of money going to be printed, not just by the Americans, but by the Europeans, by the Japanese, by the Brits, by the Swiss, by anyone with a decent currency. They're going to be issuing it in enormous quantities at the same time. So we're going to have a tsunami of money printing, and that is why gold has taken off.
Well, for sure. I mean, you mentioned, the problems of the trade war before this came up, and now the virus. With manufacturing shutting down and supply chains interfered with, prices are likely to go up because of shortages, I would imagine, which then would likely trigger a demand for higher rates when people lend their money to the Treasury, right? And so the Fed will then have to pump more and more, faster and faster, to try to keep the rates down. You also have the rest of the world still have lower rates than the U.S., so I imagine they're people trying to find some sort of positive yield. Money flows into the U.S. yet? Is that still going on, I suppose?
Well, yes. I mean, I think the way to describe the problem in America is there will only be one buyer of U.S. Treasury debt, and that's the Fed. Yeah. And that is the Fed. There's no other buyer. Now, they will have the same problem in Europe. The ECB will be the only buyer of Italian debt, Spanish debt, French debt. And the same in Japan. I mean, well, Japan is slightly different because people actually save in Japan. So they may not be in quite the same difficulties as I can see rising in America, whose savers, the only savings that Americans do, and it's the same with the Brits, is enforced through corporate pension schemes, which incidentally are all in deficit, and it's a horrible muddle. But anyway, put that to one side. I mean, nobody saves, and everybody lives paycheck to paycheck. So the only source of money to cover government deficits is basically by either raw printing by the central bank or by the expansion of bank credit. And what is happening in the repo market tells us that the banks can't expand bank credit to absorb all that debt anymore without cutting out the RV funds, the relative value hedge funds, and causing a run on the dollar. So whichever way, I think the whole system has got backed into a corner.
Yeah. So your reading is the repo situation is still problematic as nothing's been solved there. I mean, it's getting worse, if anything.
Yeah, it's still problematic. And, I occasionally look at the numbers coming out of the Fed on that. And, daily you're looking at sort of averaging about 50 billion, either being rolled or extended or whatever. And I think this morning it was somewhat more, like 70. So, that's continuing to be a problem. And it is going to, it may not get worse. But if it doesn't get worse, it'll be because the banks are refusing to extend facilities in the FX swap market. Now, if they do that, then you can see that hedge funds are going to have to start unwinding their positions. Mm-hmm. And not only unwinding their positions, but it means they've got to sell their dollars. Because that is the unwind, if you like. It's sell dollars, buy euros, or sell dollars, buy yen. Mm-hmm. And consequently, at that stage, the dollar will turn. And the thing that's fascinating about it is that everybody I talk to is convinced that foreigners need dollars.
Absolutely. That's everybody I talk to, the same thing. Yeah.
It's the so wrong. Idea. Yeah, but this is the crazy world we live in, because we have a generation of investment managers who only know an inflationary environment. They're all Keynesians, and they're completely with the Fed on this. They don't realize the danger that they face. It's an extraordinary situation.
Well, Alasdair, I think you and I are more or less the same age, so you would remember the 1980, 1981. And the high inflation in the U.S. I think you had something in the U.K. too. Yep. In those days. And our first mortgage was a 17.5% mortgage here in New York City. Yeah. So I remember the time when interest rates rose along with inflation, and people they can't get their heads around that, I guess because they haven't lived through it. But you were suggesting there that we were ready before the coronavirus came along, and that we're looking at something, in many ways comparable to 1929, at the end of the credit cycle and a trade war at the same time. And in your February 13th article, you referred to John Law's Mississippi Company, the bubble that took place then 300 years ago. Now you seem to be suggesting that we may be coming up on something as significant as that.
That is a very. I was sort of scanning for a simile, if you like, to the current situation, and it seemed to me that John Law's Mississippi scheme was a very, very good simile, because basically he did exactly what the central banks are doing today. Mm-hmm. He printed money to puff up the market, so that he could merge his Banque Royale with the Mississippi Company. It wasn't called that. It was, something in French, something to do with the Indies or whatever. Anyway, he was due to merge the two, and he needed to get the share price up. So what did he do? He printed money to buy shares in the market. And incidentally, that created an inflation of food prices, which combined with a bad harvest, was not a very good thing. We're talking about late 1719. His currency started losing purchasing power in around about November, December 1719. The merger went ahead on the 28th of February 1720. The king sold 100,000 shares at 9,000 livres to be paid out in stage payments, but that was, if you like, the thing that rang the bell. That was the coronavirus. It was a financial event, if you like, a black swan, which hit the market. And the way it worked was that the paper currency, his livre, started collapsing first, and the shares then started collapsing as well. So that by September 1720, the shares had fallen from something like 11 to 12,000 livres a share down to 2 to 3,000 livres a share. Wow. But the livre, which we're pricing it in, was worthless. Mm-hmm. So in effect, you lost everything. If you bought into the scheme. And I just see so many similarities with what's happening today on a global scale that, quite frankly, I think it's really rather terrifying.
It certainly seems to be. Another essay that you wrote just more recently, I guess it was suggesting that this whole thing could lead back to a gold standard. With 2 minutes left, would you care to comment on that?
Yes.
And then suggest that people go to goldmoney.com and read the article.
Absolutely. what I was suggesting is that because the collapse is likely to be so much quicker than I had thought before, I think that some nations, and I think this is China, I think it's Russia, some Asian states perhaps, will be in a position to say, well, we've got to save our currency, and the only way we can do it is link it to gold. So some sort of gold standard. I think conceptually it'll be very difficult for the Americans to come around to this view for two reasons. Firstly, they've spent the last 40 years damning gold, calling it bedrock or whatever. And secondly, the Fed is driven by Keynesians who do not understand prices. They do not understand economics. They understand the Keynesian version, which is John Law's version. To get that intellectual switch round to an understanding is going to require something which I cannot foresee at the moment. Right. But what we could do is, if we see one or two major players, like China in particular, if they go back onto a gold standard of some sort, then that will encourage other countries to do the same, if only to stabilize their currencies. Right.
So the Keynesians may have to learn their lessons the hard way. Of course, all of the rest of us may have to do some suffering along the way as well.
I'm afraid so, but so the question is, will they learn the lesson? I mean, I'm not sure.
In due course, they put some. I imagine they will, but as Keynes said, and we don't quote him very often, but in the long run, we're all dead. So, anyway, in the long run, our show is over already. Alasdair, thank you so much for being with us once again. Always refreshing. Well, not always the topics we want to hear. It certainly isn't the kind of thing that we want to focus on, except when we have to. And so I think it is time now. Watching the Dow go down as it is, we've got to pay some attention to what's going on. Thank you very much, Alasdair, for helping us do that once again.